The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. A 50 basis point rate cut from the Federal Reserve after their September meeting wrapped up on Wednesday. It was speculated that would be the case late last week, and that is what we ended up with. So what does a 50 basis point rate cut mean for the commodities, the livestock trade, and more? We're going to dive into it here today. Joining us for market analysis, Mike Zuzolo with Global Commodity Analytics. Mike, good to catch up with you, sir. Happy Jerome Powell Day, as we're dubbing it, as the Fed cutting interest rates 50 basis points. And I know that's going to give us plenty of fodder to talk about here today. A move that was starting to be widely expected, as I mentioned, Mike, and we got 50 basis points on Wednesday.
Yeah, I hope the listener and the viewer are ready for 20 minutes of pure, unadulterated commodity market bliss.
That's a good way to frame it up, I would say. Let's kind of dive into this. And just right off the bat, I have to think a rate cut. I immediately wonder what it's going to do for the U.S. dollar, which in turn could help out exports, et cetera. So frame this up for us, and I'll pull up our first chart on the video feed. What does this rate cut mean for the U.S. dollar and more broadly, the grain sector?
Yeah, and this is a great way to start the segment, Jesse, because we're talking about a situation where we're in harvest in the row crops. We have very strong yields being reported right now. And so the question has been, how do you stimulate a counter-seasonal rally in corn and soybeans? And the only way to do that, in my mindset, and take the primary driver of the big supplies coming on, take that and redirect the attention of the trade towards a more commodity risk-on environment. And you do that through the investment flows and the asset sectors. And what this dollar chart shows you, and it's actually made new lows since I posted this to you, we're at the lowest in the spot dollar index since July of last year. So we're hitting a 14-month low in the dollar. Key commodity type currencies like the Brazilian currency, like the Chinese currency, we're seeing a reaction there as well, a positive reaction, so that it gives you the idea that we can maybe string together another weekly high, 2 in a row for the corn, beans, and wheat, with wheat leading. And then all of a sudden, between the USDA showing tight world stocks still in last week's report, and the South American weather, which is garnering more attention as each day and each week goes by, that they don't get rain and they don't look like they're going to get rain in forecasts, all of a sudden you can start making an argument, a pretty effective argument, that we're going to have a potential for that counter-seasonal rally and break free from that 2014 market and that cycle of soybeans leading us lower. And what you saw Wednesday, and as I said before we went on the air, and I say this in all jest, I'm not really saying this to anybody in particular, but if you don't believe in the power of the Federal Reserve and monetary policy on commodities, you're deaf, dumb, and blind, because the main reason why the soybeans led this market on Wednesday before the Federal Reserve report was because the Brazilian currency had made a fresh high, monthly high, against the U.S. dollar. And I think that really charged up some of the investors to get out of their short bean positions.
Let's talk about that. That's one of the charts you sent me, and I think it's just a perfect segue here to talk a little bit more about this before we go back to talk wheat and energies. You mentioned that correlation between the U.S. dollar and the Brazilian real, and looking at a monthly chart here, and you mentioned some of the weather concerns too, that it's still early, but they're starting to get a little more chatter in South America. So continuing on with your point here, I mean, frame this up a little bit closer for us.
Well, the Fed has said now in their published minutes, they have, quote, greater confidence on the inflation side of the equation. And so when I look at this chart, I see two blue lines that form a wedge or a triangle. And whenever I see something like this, especially on a monthly chart and especially on a currency chart, I take note of that, because this market did not go ahead, and the price action did not go all the way out to the point of the wedge, the point of the triangle, and build kind of a coiling mindset of lower highs and higher lows. Instead, it broke out prematurely above resistance, the dollar gaining on the Brazilian real. And so I'm going to lay the groundwork here fundamentally now that the Fed's come out. We've got a new monthly low in the dollar against the Brazilian currency, that now that the Fed has cut rates, it gives the opportunity of other central banks like Brazil and China to cut rates as well. And what that does then is allows them to not have to defend their currencies as much, and they can pump in more of their exchange, their foreign exchange, and their government stimulus, fiscal money into their actual economies. And that's generally speaking why emerging markets do better when the dollar is weaker, because those other countries in emerging market territory don't have to defend their currency against the dollar. So what happens if we see the US dollar break all the way back down to the 5.0 level, where that old pennant, that old wedge tip of the triangle is at right now? And I think that's something that we really want to look at, because that could take a lot of pressure off of the idea of the 500 plus million bushel carryover in beans and the record high soybean stocks, just because the funds and the investors may not want to feel too good about shorting the soybeans because of the currency markets. And at the very minimum, I think it could give us some supportive features to where the downside doesn't have to be as big. And we can indeed see a breaking away of that 2014 type model year. The last thing I'll show on this chart, Jesse, and this is kind of a clinic on the technicals, is the bottom part of the chart, the white and the orange line. That is a buy sell signal for me on an oscillator. That is potentially giving us on a monthly basis the first monthly sell signal in the dollar against the real of 2024. And so that also I have to take notice of and watch for my clients and subscribers.
Mike, I want to rope in energies here too as we shift from soybeans, because I know that the broader global energy markets can have an impact here as well, and especially when it comes to oil seeds and the broader oil seed market around the world, et cetera, and thinking about crude, ethanol stocks, et cetera. I know we got fresh DOE data out Wednesday morning ahead of the Fed news. So tie this in here. What could we be needing to pay attention for in energies right now?
Yeah, great way to put it. The key with the wheat market typically is crude oil and copper and some of these other leading canaries in the coal mine when it comes to interest rates and monetary policy and fund investment. And what we see in this chart, and I've highlighted other times in 2021, I didn't highlight the time in 2022, but you can look in December of 2022. The black line is where we are on crude oil or crude stocks here in the United States. We dropped down to 417 million barrels today on the weekly numbers. That's the lowest in the Midwest in a decade. So we've got one of the tightest stocks in crude oil in the United States, and yet we're still dealing with $70 crude oil. And we've got pagers and handhelds being blown up all over the Middle East the last 2 days. And the likelihood of a wider, bigger Middle Eastern war probably at its highest level since the October 7 slaughter by Hamas. And so I went back and I looked at the energy stocks, the geopolitics, and it's interesting, and every year is different, but it's interesting whenever we had these kind of stock levels of 414 million, 417 million, when we get down this low, the crude oil tends to find some support off of that if the US dollar isn't pushing on it because the dollar's rallying. So this is one of the leading dominoes for me to fall here, Jesse, is to see if this crude oil market, the futures market, which is in the purple line, can't break higher and go essentially from $70 up towards that $80, $85 level like we did in 2021. And again, we did the same thing only all the way up towards the $90+ level last year, right around this same time period, September, October, November. So pretty neat looking chart. And this would add, in my mind, even more support to the wheat market in that counter seasonal rally. And we have to throw in there with the wheat, the very dry weather in hard red wheat belt, the Russian wheat belt. The Russians are slowing down their planting based upon some of the updated analysis and reports I'm getting right now, because they're as dry as we are. And I heard from a person in the Ukraine area that the southern Ukraine area is the the hottest it's been in at least 100 years. And so we've got a lot of potential kindling here for the fire, but it starts with the crude, the copper, and the wheat market. And the Fed has set us up. So I'd be disappointed if I didn't see a good, strong commodity reaction in this market.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on the show as we're discussing some of the impact of the Fed 50 basis point rate cut here after their September meeting and more, and the impact on commodities, and talking about wheat and some of the correlations and watching this wheat market. You looking at it being a leader here. I know we've seen SRW futures have kind of bumped up against some resistance around that $6 level here as of late. I feel like talk about that and talk about this chart looking at SRW futures as it relates to the Russian ruble and some of the things you're watching there in terms of this wheat market.
Yeah, that you said it all perfectly. And there's one time in that chart in March of 2022 when we made the major high in soft red wheat, which is your green line, and we made the major low in the ruble against the dollar. Same exact time period, same month, and that was because of the actual invasion. We've essentially spent this past 2 years unwinding that type of mindset and that shock. Now we're back to trading like we normally do, where if that ruble starts to go down or it's capped against the dollar, then that tends to cap the soft red wheat. So you've got the ruble, the real, and the Chinese yuan as your three major currencies to be watching here if you do what I do in the analytical space.
All right. So a lot of things to keep an eye on here in the grains, and we'll be waiting to see how things close out the week. I think that's going to be a big key here. Let's spend some time in livestock and talk about the impact of a rate cut there. I'll pull up negotiated cash cattle chart first, and that's correlating with CME cattle futures. Talk about what you're watching here, Mike, as we kind of set this up and talk about a rate cut in terms of livestock.
We've had a lot of tailwinds in the cattle market up until today, Jesse, and I'm hoping that the Federal Reserve rate cut, being so aggressive, brings in the funds and gives them the ability to want to go net long in the cattle and the feeders like they have started to in the hogs, and we'll talk about that in a minute. But I think the key with this chart is that earlier this week, just yesterday, in fact, we were back up to 183 plus in negotiated cash. It looked like the packers were buying pretty aggressively. Now we've slipped back below 178, and we actually have now taken that negotiated cash cattle price below the October futures. Now, this is important not just because of the fact that we've no longer got a premium in the cash market. It's important also because I have to now say that if the Fed is done raising rates and they're ready to start cutting rates, what does that say about the stock market? Do we see an asset rotation out of the stock market? Because the stock market's priced in for the better part of 3 to 6 months, the shifting in the bonds and the expectation of this change in policy. And it's not uncommon to see the bonds go higher and the yields go lower because they work opposite one another. But when those bonds go higher, at some point, that tends to detract from being long the stock market. Well, we've just been in a really good situation the past 2 to 3 weeks where the risk on trade in the stock market has been kind of a positive on the demand and consumption because some of the economic reports have been very strong and the stock market's reacted to that. And I think the cattle traders have seen that. The investors have seen that who trade cattle. And so I'm starting to get a little bit more nervous again after feeling very, very good about the cattle market this week and the chance for us to go up another leg and get hedges on. So again, I'm relying a lot upon the Federal Reserve here. And as you say, the weekly close is extremely important. And back on the corn market, just to give you a for instance, that D's high in the futures was September 6th. That's our September high for the month in December futures in corn. 416, we tested 415 today. So I would be sorely disappointed if we weren't through the 416 level on a weekly close, given this Federal Reserve rate cut.
That's a good point. Very, very true. You mentioned hogs too and some of the fun movement there. One more chart for us to look at on the video feed. Looking at some of the funds and managed money here in this hog market, what are you seeing on this chart that's maybe some indicators you're watching right now?
Well, we're running into kind of crosswinds at this point in the hogs. We're starting to see some slippage again in some of the poultry and pork prices in China, and so I'm taking note of that. But this chart surprised me last Friday when it showed that the managed money funds were turning into a bigger and increasing net long position again in the hog complex. That would be, I think, really good news to see that type of movement in another third consecutive week this week of increasing net longs. If we could see that on Friday, because that just adds more support to the cattle. And I say that especially in light of the fact that we've got that big cattle on feed report on Friday. And I'm still feeling a little bit nervous about the cattle on feed report because of that big placements number last month. I'm sure hoping that the placements number is better or higher, lower than 99%. That's the average trade guess for Friday's numbers, because we had that extra 3% in there from last month's report that we weren't expecting. So I'm hoping maybe we push some in extra a month ahead and we see a bigger break, maybe closer to the low end of the trade guess of 94% placed for August, because of that bigger number that we saw last month. Otherwise, we're going to need to rely upon more, like the hogs, like the stock market, I'm fearful of, and the Federal Reserve rate cut, if we don't get those, supportive numbers on the cattle and feed.
Well, let's close this out here today, Mike. And I think about this too. Some of the other markets, cotton's had some volatility here this week. Some of those softs, thinking about the dairy market, the volatility has been there. Obviously, a quieter day in row crops, wheat, livestock here. The Fed news, of course, the big news. And as we both mentioned, that weekly finish, I think, is going to be key. So to sum this all up, what would you say to folks as they're thinking about the risk management side of this, watching these markets? I mean, what do you really want to reiterate to folks here today, Mike?
I would say we're still trying to get that wheat-led rally to break free from 2014, because we still have a lot of high supplies in the soybeans, both domestically and globally. I'm hearing yields being disappointing in some areas for beans, but the weather did hit the moisture levels big. And so I'm not saying that we can't be lower on yield. In fact, I'm at a 52.4 or 52.6 yield number nationally, and still sticking with that 181.9 on corn. I feel very good about those numbers right now based upon what I'm hearing from clients, Jesse. But wheat, after the September expired last Friday, Dees fell and filled the gap that the September left on the weekly chart at around 571, and now we're back up above that level. With this Federal Reserve rate cut, I would think that between the currencies and what's happening in the Black Sea, in the Red Sea, we could see that wheat market see a little bit more short covering and lead us to the upside, support that corn, take us over 416. Then we don't have to worry about the beans. And in fact, maybe the bean weather becomes more of a leader to the upside for the soybeans, because wheat and corn are underneath us. Cattle, it's a little bit more difficult, a little bit more nuanced. So get a hold of me one-on-one and we can talk about that more.
Well, folks want to reach out and talk with you and take a look at your analysis and more, Mike, what is the best way to get in touch with you?
Best way is to go to globalcomresearch.com, and it's globalcom with 2 M's, research.com. You can sign up for a 2-week free trial. Please do so, and I'll call you at the end of that and talk to you and see if you like the trial and see if you don't want to work with me.
Well, as again, we talked here today and said earlier, happy Jay Powell Day, the chairman of the Federal Reserve. A little bit of euphoria on Wall Street. We'll see if it holds. We'll get those weekly closes. But again, a 50 basis point rate cut from the Fed after their September meeting. Good stuff as always. Mike Zuzolo, Global Commodity Analytics. Thanks for joining us here today on Market Talk. We appreciate it. We'll talk to you next week.
Thanks, Jesse. Let's hope the LaSalle Street feels some of that euphoria as well.
Absolutely. Mike Zuzolo with Global Commodity Analytics again joining us here today for Market Talk.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.